got Rich from Chi-Town. Hey, guys. Thanks for the great show and entertainment. Well, thank you, Rich. I am a few years from retiring and have a question about the 3-bucket withdrawal strategy. If I understand it correctly, the first bucket is short-term money, cash, 1 to 2 years. Second bucket is midterm money, bonds, 3 to 9 years of expenses. And the last bucket for the longer term, stocks. They say this is good since the 3 to 9 year bond bucket would carry you through a recession without you having to touch the third bucket of stocks. If correct, my question is, how would this work if you had a large portfolio? If you had $3 million and needed, say, $50K a year, doing the above would put you in an allocation of about 85% stocks and 15% bonds. Isn't it too risky? Does the bucket approach make sense for higher portfolios? Thanks.
Great question.
Buckets. What say you there, Big Al? What's your answer of this question?
Well, let me see
Rich?
if I can sort of paraphrase the buckets of money strategy. So I guess the idea is you have really safe assets in the short-term bucket because that's what you're going to draw upon for the next year or two, maybe 3, whatever.
Annuities and non-traded REITs?
Absolutely not, but that did happen. And then the second bucket is kind of like
annuities and non-traded
mid-range.
REITs.
Yeah, that's exactly what was in the second bucket, and that there were some issues there. Anyway, that's a whole other show topic. And then the long-term bucket is your stocks, your long-term money. And
variable annuities.
Yeah, there was a few stocks in there, I think. Anyway, the concept is fine. I guess we would say it differently, though.
Sure.
Yeah, so although I like the concept, I'm going to tell you how we would think about this, which is kind of get rid of the buckets of money idea. Although it's not necessarily bad per se, but I would say this first. There's a couple ways you can go about this. One is, Rich, to figure out what your spending needs are, and it sounds like you already have. That's $50,000 a year. Okay, so let's make sure you got at least 10 years of safety. So that's 50 times 10. That's 600,000. That's probably where you came up with the 15%. I'm guessing of the $3 million. That is a way, but that's only one way to figure out exactly what you want. That's one approach. Another approach, go at a different direction, which is the $50,000 out of your portfolio, $3 million. What rate of return do you need? Right, and the rate of return is probably relatively low at $50,000 on $3 million. That's probably, what's that? That's 1.5%, maybe, something like that, lower than 2%. So in other words, you don't have to take much risk. You could have a much higher bond portfolio if you want to. On the other hand, because you have not that huge of a need, you could take bigger risks. So now I'm going to go back to what's your long-term goal? Do you want to grow this thing for your kids, for charity, or are you good with where you're at? You just want to be safe. You don't really want to be bothered with the ups and downs of the market. You've got a little bit of latitude there.
Right. I got a few comments.
Okay.
Yeah. Given the bucket strategy, there's multiple bucket strategies. There's just an individual here, used to practice in San Diego, that had a book that was called that. Anyway, but no, I like this strategy a lot, actually, in regards to looking at having different components, if you will, to say, hey, over the next 10 years, just be very safe, because there's very rarely have you seen a 10-year period where a globally diversified portfolio has lost money.
Yeah, so make sure you got 10 years of income needs and really safe money that you can withdraw.
Right.
Regardless of what the market does.
But then I'm looking at Rich's point. He's like, well, wait a minute, man. I don't need a ton of money.
Right.
And if I got several $1 million, does this even make sense? So how you have to look at it is a few different things. That's kind of the first step. It's like, all right, well, here, you need $600,000.
That's where you start. It's not where you stop.
Yeah,
that's
right.
where you start.
That's where you start, and then you're like, well, wait a minute. This is a lot of risk here.
Yeah, because you're telling me the rest in stocks. That seems like a lot.
Right. So there's something that's called risk tolerance and risk capacity. We've talked about this a little bit in the past. And it's like a lot of times it's the opposite, where people have to take on maybe a little bit more risk than what they're comfortable with. Because
they need too high of a rate of return.
Yes, they need to generate a 4, 5, 6% rate of return versus maybe just sitting in cash or T-bills.
Right.
And so there you have to push that individual to say, hey, you might need to take on a little bit more risk to outpace taxes and inflation and accomplish your goals. On the flip side, Rich here, he could sit in cash and accomplish his goals.
Right.
Right? But is that the prudent thing to do? So I agree with you 1,000%, Al. It's like, all right, well, here, I think you're fine. What you could do, Rich, is say, all right, let's carve this stuff out so I know that I'm going to be safe for the next 40 years. He's only 56.
Right.
So then no matter what happens within the markets, within the bond market, stock market, you and your family are going to be fine. You throw a different what if in there, a long-term care stay, all sorts of crazy expenses. And then after that, you could say, well, I still have these dollars here. Maybe you want to take on risk for that, for your kids, your grandkids, for charities or things of that nature. So it really depends on his goals and what he's trying to do. But here's what I would say. I would take the least amount of risk possible to accomplish your goals.
Yeah, I think that's the key, right? So make sure you got 10 years of safety and then take the least amount of risk to accomplish your goals on the rest of it.
Right. And those goals could be several goals. It could be, all right, I want to make sure that I have a little bit for my kids. I want to make sure I have a little bit for some charities, for my church, and blah, blah, blah.
Yeah, long-term care. And a lot of folks, when they actually do retire, they end up spending more. They travel more, right? They spend more on hobbies. And it's like you're maybe around the house more. And it's like, oh, gosh, it'd be nice if I had a patio. So then you go out and buy the lumber, or you hire someone to do it, and all of a sudden you're spending more money.
So I would encourage Rich to spend more money, but if you're 56 and you got $3 million, he's a pretty good saver,
right?
Unless he inherited it all, which could be a possibility.
Or he
as well.
worked for a company that had stock options, or
he just
business
got
owner,
really lucky,
or real estate.
He probably hadn't saved a dime in his life, and
lottery winner.
Yeah.
There it is.
That's our 2 cents, Rich. Appreciate you tuning in to us and writing in.